Hello everybody. I hope all of you are doing really well. My name is Siddhant Mehta and welcome you all to Raftaar batch. Today I have two instructions for you. The very first one is about feedbacks. A lot of students are giving their feedback that they are able to clear their exams with the help of our ultimate last minute notes and revision lectures. Where one student says that he just studied for a day and cleared the exam. One student referred our material, studied for just 6 hours and cleared her exams with 60 marks. There is one more student who found our notes helpful and cleared the exams with 65 marks. So here our intention behind preparing all this material were that you must be able to prepare for the exams in less time possible and also in efficient manner. With that, we also want you to have a conceptual clarity. So we are providing revision lectures with it. Hence, the first instruction is to give us your valuable feedback. If these notes, if these revision lectures are helping you to clear your exams, give us your feedback. It really helps us to understand how these things are helping you, and also it helps us to improve. So the first instruction is give your feedback, and the link for the feedback form is in description box. The second most important instruction is to subscribe our channel, because the way we are delivering value to you in set C, in the same way we are going to deliver the value to you in set D, and the batch for the set D will be announced soon. Now let's revise chapter number 5, that is valuation standards. Let's first understand how is the structure of this chapter. Here first, they have covered some basic things like what are the purposes of the valuation standards, the structure of valuation standards, and the boundaries of valuation standards. Here, all these things are simple, but don't skip it, because ICAI is asking some basic questions on it, like which of the following is not the purpose of valuation standards, which of the following is the boundaries of valuation standards. They are asking question on it. Hence, we will cover it, and then we will go to the 8 valuation standards which are given in ICAI module. Here, the best thing is we have already covered 5 valuation standards in our first 4 chapters. Here, ICAI has not copy pasted the entire valuation standards to you. They have extracted some relevant part and included it in your syllabus. Hence, all these things have been already covered in your first 4 chapter. Here, we are going to cover the things which are there in yellow. And my friend, all these things are just 1 or half pager concept. Like valuation standard 101 is about definitions. We have already covered relevant definitions in a respective chapter. Here we are covering the few definitions which are left. Then valuation standard 102, valuation basis, is already covered in chapter number 1. Valuation standard 103, which is about valuation approaches, it is covered in chapter number 3. And here we will be covering some few terms like discount of lack of marketability, discount for lack of control, and synergy. Then valuation standard 201, that is your scope of work analysis and valuation. We will be covering it here. Then your valuation standard 202, reporting and documentation. This has been already covered in chapter number 4. Then valuation standard 301, that is business valuation. We already know how to value a business based upon these 3 approaches, hence this is already covered. Here we are going to cover about due diligence. And then there are 2 standards which we will cover here, that is intangible assets and financial instruments. So this is the structure of your chapter number 5. Now let's first understand what is valuation standards. Valuation standards are a set of principles, set of guidelines which valuer has to follow in each and every valuation assignments. So what are the purposes of valuation standards? Why we even need valuation standards? We need valuation standards because there should be a consistency in data. If each and every valuer prepares his report and does the calculation based upon valuation standards, hence there will be consistency in data. Also, if investor wants to compare the valuation of 2 companies which have been prepared by different valuers, but they have been prepared based upon valuation standards, hence it will be easy for him to compare, because the structure of the valuation report will be as given in valuation standards. Then this is your first thing, consistency and comparability. Second, in standards they have given a rigorous process which valuer has to follow at the time of deriving the worth of a company. and it also issues guidelines which valuer has to follow to become independent throughout the valuation assignment. Hence, all these guidelines and all these rigorous processes build trust among stakeholders, build trust among investors who are reading this report, which are prepared based upon standards. And second purpose is reliability and trust. The third one is transparency and disclosures. These standards tells a valuer that you have to give sufficient information in valuation report, by which valuer must have transparent picture of the valuation. Hence, because of these standards, there is transparency and disclosure. Fourth thing, risk mitigation. There are proper steps given in standards which valuer has to follow. Hence, there are less chances that he will be biased and he will miss some of the steps. Fourth is risk mitigation. Fifth is compliance with regulations. As we all know, regulations referred to standards to derive the value, that you have to derive the value based upon the standards. Hence, if there are standards, there will be compliance of regulations. This is the fifth purpose. And the sixth one is professional development. Standards gates keep on changing based upon the industry practices. Hence, if any valuer is following these standards, he will have continuous learning about the industry practices. This is the six purposes of having valuation standards. Now let's understand the valuation standards which are issued around the globe. Here they have given us some information about the standards which are accepted internationally, then some standards which are accepted in their respective foreign countries, and some institution name which issued these standards in their respective countries. The first one is International Valuation Standards. It is issued by International Valuation Standards Council and provides global valuation principles and methodologies. The second one is European Business Valuation Standards. It is developed by TIGOA. TIGOA is the European Group of Valuers Association, and it is for business and intangible assets valuation. Then there is CICBV, that is Canadian Institution of Chartered Business Valuers, Practice Standards and Code of Ethics. It defines valuation methodologies and ethical guidelines which are there in Canada. Then Royal Institution of Chartered Surveyors. These provide global valuation standards, notably called RICS Red Book. This is important, and this institution is based in UK. Write this down and remember that they have issued valuation standards which is called as RICS Red Book. Then there is American Society of Appraisers, which offers valuation standards across various disciplines, and it is based in US. Then let's understand the structure of valuation standards. What all things which are there in valuation standards. The first thing is there is purpose. These standards will tell you for what purpose you have to refer these standards. Second, it will also give you the fundamental concepts and valuation methodologies which you have to use in valuation assignment. Third, it will also define some terms. If there are any terms which are creating ambiguity, it will define these terms to have a clarity and to have a standardized definition. Fourth, it will give you valuation approaches and the methods which will help you to derive the value of any asset or a company. Then it will also tell you if there are any risks, if there are any uncertainties, how you have to incorporate such things in your valuation. And then it will also tell you how you have to document and how you have to report your valuation assignment. These are the things which are there in valuation standards. Now let's understand the boundaries of valuation standard. The first one is scope limitation. These standards will tell you on which specific assets or entities they are applicable. Hence you have to apply the standard for that purpose only. Second, these standards, like I said, issues ethical guidelines which valuer has to follow to be independent, objective, and to maintain integrity. Third, these standards make valuers comply with all relevant laws and regulations. Then these standards are prepared in such a way which understands the local conditions but also aligns with international practices. Hence the fourth point is global applicability. Fifth point is updates and revision. These standards get periodically revised to incorporate new methodologies and industry advancements. Hence, there is no sixth point. It is just the conclusion that because of these things, it ensures that there is ethical, legal, and professional compliance, and the stakeholder will maintain trust in valuations. Now, let's understand the principles which are there in international valuation standards. They have the same principle that the valuer must be independent and to maintain objectivity and your integrity. Then he must prepare a transparent report. He must be professional, competent. He must have a relevant experience and expertise before accepting the work. He must follow the code of ethics, that is ethical conduct, and he must prepare the report on consistent basis, which is easy to compare. All these things are principles underlying international valuation standards. Then the ICAI valuation standards have described some qualitative characteristics of a valuation report. The first one is understandability. Your valuation report must be clear and comprehensible for reader to understand. Second is relevance. Your valuation report should cover all the relevant things which helps the reader to understand the valuation assignment. The third one is materiality. All significant information should be included in report. Then fourth one is reliability. Your report should be free from any error and biases. Then the fifth one is faithful representation. You have accurately depict what it claims and what it represents. You have prepared the valuation, and the value which you are showing is accurately depicting what it claims and represent. Then substance over form. It means based upon the standards have told you that you have to disclose so many things, but if valuer thinks that I may have to include 2 to 3 more information which will give a better picture for a reader, then he must include these information. That means valuation should reflect the economic reality of the transaction rather than just a legal form. Then there is neutrality. Your report must be unbiased. Then prudence. As we all know, in valuation assignment we have to apply various judgments. At the time of applying judgment, you must be cautious. And then there is completeness. Your report must include all the necessary information which is material, and it should avoid any misleading information. All these things must be there in your valuation report. So there are 8 valuation standards. In that 8 valuation standards have been divided in 3 parts. One is technical standards. These are your first 3, that is 101, 102 and 103. Then there are performance standards which are 201 and 203, and then there are application standards, that is your 301, 302 and 303. Let's understand valuation standard 101. This standard is about definitions. Here I have extracted the definition which are there in valuation standards. I have not summarized it because sometimes ICAI is asking some basic questions like which of the following is the definition of value as per valuation standard 101. So you must be prepared for it. The first one is active market. Active market is a market where the transaction for the particular assets or liability are in sufficient frequency and volume is called active market. Then what is control premium? We'll understand this in few minutes. What is discounting rate? We have already covered in chapter number 3. What is liquidation value? We have already covered in chapter number 1. What do you mean by observable inputs? These are the inputs, facts or information about any actual event or transaction from publicly available information, that is from publicly available data, is called as observable inputs. What is orderly liquidation? This is something which we covered in chapter number 1. Participant specific value, already covered in chapter number 1. What is present value? Present value is nothing but the today's worth of future cash flows. This is an integral tool used in income approach to link future amount to a present amount using discounting rate. Then what do we mean by rule of thumb or benchmark value? This is important. So if you want to calculate the worth of your company and you just check that a peer company which has same revenue and same business like yours is worth 9.6 crores, and you did your calculation with the help of DCF approach and found out that the valuation of your company is 10 crores. So now you can see, okay, my valuation is close to the market valuation. I can say my valuation is precise. But if your valuation here comes out to be 6 crores, then you would be worried that your valuation is not accurate or your valuation is not as per market valuation. Here you can see you have used that 9.6 crore as a benchmark value to compare your valuation. So this value is a rule of thumb or benchmark indicator, is used as a reasonable check against the values which are determined using other valuation approaches. This is your rule of thumb or benchmark value. And what do you mean by value? Value is the last amount which you get after applying all your valuation procedures. Whatever the amount which you are going to get is called as value. Now let's understand valuation standard 103, that is valuation approaches and methods. Here we have already understood the generally accepted valuation approaches and their respective methods. We have also understood when we have to take multiple approaches at the time of deriving the value of a company. But here ICAI has covered one specific illustration about it, hence we have covered one illustration about multiple approach in this chapter. Here they have calculated the worth of ABC Limited, that is value per share, through three different approaches. With the help of income approach, the value is 100. With the help of market approach, it is 90. And based upon cost or asset approach, it is 80. We also know in multiple approaches, we assign weights. These weights will be decided by the valuer based upon his experience and his expertise. So then we will assign weight and we'll multiply these weight with the respective value, and we will derive the value of per share based upon multiple approach. This is a simple calculation which we have already learned and discussed in chapter number 3. Now let's understand the adjustments which are there in valuation. All these adjustments are important, and there are three adjustments. The very first one is discount for lack of marketability. The second one is control premium and discount for lack of control. And the third one is synergy. So here we apply these discounts once we calculate the value of a company. Now these adjustments are not there for each and every company. Whether you have to do these adjustments will depend upon the nature of transaction and upon the size of a transaction, and whatever is the net value will be the value of your company. So the first adjustment is discount for lack of marketability. Here you discount or you reduce the asset value because these assets have restriction on selling. To give you an example, if I have listed shares with me, I can sell those shares by just clicking on one button on my Zerodha app, and I can sell those shares. Here I have that privilege, but the same privilege is not there with me when I have unlisted shares with me. Here there is no active trading market for these shares. If I have to sell those shares, I have to search for a buyer, and all these process will take time. That's why for investors these shares are not very attractive, because there are transfer restrictions once they bought these shares. Hence, to make them attractive, we discount their value. This is your first thing, that is discount for lack of marketability. There are various methods to calculate this discount, that is cost of illiquidity. The first method is deducting future selling cost. Here you will understand what will be the transaction cost which you will incur at the time of selling such asset, and you will discount it, and you will calculate the present value of this transaction cost and will reduce it from your asset. The second method is increasing the required return for illiquid asset. Here you will not discount the asset value. Here you will promise that you will give him the higher return, and that extra return will help you to compensate the time which is required to sell those assets. The third one is valuing liquidity as an option. So here you can see in listed shares, I have one privilege, I have one option that I can sell those shares when the price is high. But the same privilege, the same option is not there with me in unlisted shares. Hence, I will calculate this option value with the help of option pricing model, that is your Black-Scholes model. These methods, ये जो मेथड है ना Black-Scholes मॉडल और ऑप्शन प्राइसिंग मॉडल, ये आपके सिलेबस में नहीं है. जो डिफिकल्ट है वो आपके सिलेबस में नहीं है, जो इजी है वो आपके सिलेबस में है. Hence, we will calculate the option value and we will reduce it from your value of your asset. This is your third method. And the fourth method is you will understand what is the transaction cost of liquid asset. If I have to sell this liquid asset, what is the transaction cost of it? And what is the transaction cost if I have to sell illiquid asset? Whatever is the difference, you will consider it as a discount and I will reduce from the value of your asset. These are the 4 ways in which you can calculate the cost of illiquidity. Here you can see we have referred transaction cost a lot. What do I mean by transaction cost? Transaction cost is your directly attributable cost, which is your brokerage, commission, marketable cost, but it doesn't include your indirect cost, which is market impact cost. Sir, what do you mean by market impact cost? Market impact cost is a price change which happens when a large quantity of your asset gets bought or sold in the market. To give you an example, if investor sells a large number of shares in the market, as we all know, the price will drop because there is excess supply in the market. If investor buy a large number of shares, the stock price will rise because there is increase in demand for that shares. So here there are two type of market impact cost. The very first one is short-term price change, which will happen during a trade, but that price will also recover later. The second is permanent market impact cost. Here there will be a long-term price change due to new market information from the trade, and your price will not recover. To give you an example, suppose there is a stock in trading that is of 100 rupees, and the investor sell a huge quantity, because of which there is excess supply in the market and price drop. Your price dropped to 95 rupees, but later on your price recovered to 97 rupees. So here if your price but later on your price recovered to 100 rupees. So here you can see there was a temporary impact. The price dropped, but again it recovered. So if this situation happens, it is called as temporary. But if your price stayed at 97, then we can say that there was a permanent impact of 3 rupees. So these are the two types of market impact cost. One is temporary, one is permanent. Then there is your second adjustment, that is control premium and discount for lack of control. We have already understood about control premium in our chapter number 2 with the example of BB virtuals and Veranda learning, where I have explained you that BB virtuals have sold 51% of their company. So here they have not just given the ownership of their company, they have also given control of their company. And if anyone is giving control of their company to the acquirer, he will definitely ask a premium for it, and that premium is called control premium, the extra amount which is paid by the acquirer to gain control. And now that acquirer will have influence over business operations, strategy and financial policies. This is your first adjustment, control premium. And the second one is discount for lack of control. So if anyone who is getting few percentage of your shares, like 2%, 3%, and this investor knows that in this percentage of the shares, he will not have influence over company. Because of this, these shares are less attractive to the investors. Hence, to make them attractive, we discount it, and this discount is called discount for lack of control. Then your last adjustment is about synergy. We all know what do we mean by synergy. Synergy is when combined asset value is more than their individual value. When two or more assets or business gives greater value and benefits than their individual value is called synergy. There are three types of synergy. The first one is revenue synergies, which is also called as growth oriented. The second one is cost synergies, which is also called as efficiency oriented. And the third one is financial synergies, which can give you capital and tax benefits. So to achieve revenue synergies, you can achieve it because now you have expanded customer base. Now you have shared distribution channels. Now you can also cross-sell each other products, and because of reduced competition, you can give a better pricing of your products. But whether your company is going to have revenue synergies or not, this is something which is least predictable, because all these things are dependent on market conditions. Even though you have given better pricing for your products, but whether customers are accepting your products, all these things are dependent on market conditions. Hence, revenue synergies is least predictable. The second one is cost synergies. Here you can achieve it by employee reduction. Second, you have achieved economies of scale. That means your production is increasing and per production cost is decreasing, by which you can have cost synergies. And this synergy is something which is most predictable, because reducing the cost is under management's control, right? Hence, this synergy is most predictable. The third one is financial synergies. You can achieve it by framing some tax strategies. Now you are having better borrowing power, and also you are having stable cash flows now. But whether your company or your combined entity has achieved financial synergies or not will depend if your combined entity's weighted average cost of capital is lower. If your combined entity's WACC is lower, then we can say that you have achieved financial synergies. So here you can see the cost synergy is something which is most predictable, and revenue synergy is something which is hard to predict. This was your part 1 of chapter number 5. Within a few hours I will upload part 2. Stay tuned. Tata, bye bye, see you in next lecture.